most students study the income statement, balance sheet, and cash flow statement separately. That's the main reason finance feel confusing. In reality, these four financial statements are not separate documents. These are the one connected system. Once you understand this connection, exam become easier and real business numbers start making sense. Professional exams like CMA don't test memorization. They test whether you understand how numbers flow from one statement to another. In this video, I will explain the big picture. No accounting standard, no complex rule. There are four core financial statements. The income statement, show the performance over a period. The balance sheet, show the financial position at a point in time. Cash flow statement, show actual cash movement. And the statement of changes in equity, explains movement in owner's fund. Now let's see, they are connected. Everything starts with the income statement. It answers one simple question. Did the company make a profit or loss? Revenue minus expenses give us net profit. But there is most important point. Profit is not cash. For example, a company report high profit but still struggle to pay salaries or suppliers. This is because revenue may be recorded but cash may not be received. Profit shows accounting performance, not liquidity. And this difference is exactly why we need the cash flow statement. Net profit does not stay the income statement. It moves into the statement of changes in equity. This statement explains what happened to owners' wealth during the period. We start with the opening equity. We add profit earned during the year. We subtract dividend paid to shareholders. And if new capital is introduced, we add that. Many students ignore this statement. It explains why equity changed, not just how much it is changed. This gives us closing equity and that number has one final destination. The closing equity appears in the balance sheet. The balance sheet is a snapshot at a specific date. It shows what the company's owns asset, what owes liabilities, and what belongs to owner's equity. The fundamental equation is always same. Asset is equal liabilities plus equity. The balance sheet does not show performance. It shows the result of all past business decisions. That's why two companies with the same profit can have very different balance sheet. Now come to the most misunderstood statement, the statement of cash flow. Remember this clearly. Profit is accounting, cash is reality. The cash flow statement explains why cash increased and decreased during the period. It starts with the profit. Then it adjusts non-cash items like depreciation. Depreciation reduces profit but does not reduce cash. So, we add it back in the cash flow statement. Working capital changes explain timing differences between profit and cash. Finally, it shows cash from operating, investing and financing activities. The closing balance sheet here must match the cash shown on the balance sheet. So, the full connection is simple. The income statement creates profit, profit move into equity, equity appear in the balance sheet, and cash flow statement explain how cash on the balance sheet actually moved. All four statements are telling one financial story. If you pause the video here and rewind this flow once, you will never forget how the four statement connects. In exam, they do not ask definitions. They ask questions like, if profit increased, what happened to equity? If cash decreased, where did the cash go? If you understand the connection, these questions become easy. In the next video, we will break down the income statement step by step. Always remember, these four statements are not four topics. These are four views of same business. Thank you for watching this video.